keep on schedule.
Okay.
So welcome everybody to our first Vidi seminar of the 2025-2026 season. This will be the first of, I think, probably miscounting four talks in the fall, and then we'll have some in the spring. Um, and we are excited to have Jin-Hyuk Kim from Colorado, University of Colorado, speaking to us about platform screening, investor learning, and default risk in marketplace lending. We're going to follow the same format that we've pretty much always followed in the seminar for those of you who are returning. Jin will talk for about 45 minutes, largely uninterrupted. If you have any questions, add something to the chat, and either Tommy or myself, who are moderating, will try to accumulate those questions. We'll either hold them off to the end, or if they're kind of like a clarifying question that makes some sense to ask, at that point we might pass them along to Jin, and then at the end we'll have like 15-minute dedicated Q&A session. Okay, well, without further ado, let me turn things over to Jin.
Okay, thank you. Thank you for this opportunity to present our paper. So I'll try to see if I can go a little bit faster. So this paper is joined with Peter Newberry and Nick Vikander. It's about platform, how they screen the investors, and investors learn from observing the outcomes on the platform. And the platform is about the marketplace lenders, crowdfunding. So sometimes the project owners default. So this is the setting for our study. Wait, uh, hello, are you there?
Uh,
Okay, is slide is not moving suddenly.
Sorry. I'm guessing that's on. So is it
Okay,
moving?
okay,
Yeah.
I'm doing it manual. Okay, that's fine.
Okay.
Okay, so this is imagine so think of an imaginary platform, quote unquote. So this platform is about crowdfunded for open to the public, and they crowdfund inventories. So these small businesses, they have to build inventories because inventories takes money, and they don't have enough money, and they raise the funding from by promising to sell their inventories once they build it up. So they're gonna, give the money to some manufacturer, they're gonna ship it to themselves, and then they have to sell. So this platform accepts all the small business, targeting small businesses, and they must have some retail products. So it just can't be just tech product. So investors are essentially funding some actual products, and they offer maybe some of you are already familiar with Kickstarter and etc. or Prosper, um, and they offer these loan terms. Whether that is actual loan or not is still kind of debatable. It's grayish area, but they do offer. Okay, if you invest $100, we're going to return $110 in say 6 months, and then in particular. In this case, they will offer to return it in installments. So in three different installments, I'm going to offer you one third of that return principal plus interest over, say, 6 months term or whatever months term, etc. So this is the where our data comes from, and we wanted to study what's going on in the small in the ecosystem. So our conceptualization of the research is that the investment often, not often, but sometimes fails, and investors don't get their money back. So what's the investor's thought process? Investors think could be first possibility is that, oh, the investor, the project defaulting could be just some bad luck. So it's an idiosyncratic luck. So it's not going to affect me, the investors, in any way. So I'm just going to move on, and my behavior will be as normal, as if nothing had happened because it was just an idiosyncratic bad luck. Or the investors experiencing a default could blame the platform. Oh, the platform should have screened better. They didn't do a good job in screening and letting out a good project that wouldn't default, for instance. So they're going to have something about that platform. The third possibility is about, I'm an investor, but I probably didn't select into a very good project. So I don't have enough, the animal spirit to select a project that's not going to default. So in some sense, it's an added fault on myself because as an investor, I didn't get to choose the right one. So our research question was among these possibilities, we were going to focus on we're going to call the project default rate at the platform-wide scale. We're going to call that a public signal. So by observing the other project that I, as a user, didn't necessarily invest in, I can get to see publicly what the platform's signal is on their due diligence level. Or it could be that if default rate among those projects I had invested is high, that it's going to affect me disproportionately high, then it means that there's an effective private signal that's coming out of my own private investment, not others' investment, but my own investment. So that should signal something about my ability to select a good project, for instance. So these two signals are capturing the main element of our empirical exercise, and then we're going to model how these two signals will affect the user preference, behavior choices, and eventually how much money the crowdfunding platform will be able to raise. Um, and then we're going to say something about their conjecture about their screening level, etc. Okay. So some literature, this our paper builds on the so-called certification hypothesis, which I think originally originates from the IPO literature, where these underwriters they trying to sell the equity of a small unknown firms to the public for the first time. So there's a lot of insider information, and the idea is that the underwriters, investment bank, they put their reputation onto their sales. And similarly, more recently in Marketplace in Bovard and Levy, they expanded this literature to two-sided market where there's a buyer and seller. And the result is that you don't want to be too stringent as a certifier because then no buyer was going to come to you for getting certification because they're not going to get it. If you want to be too lenient, then again, it's not adding very much value. So it's sort of a non-linear relationship. So what we're gonna do a little bit differently from these two strands of literature is that we're gonna focus on the platform's monitoring activity. So in this, based on a lot of discussion about this platform, users talk about whether platform actually monitors these contracts after the projects are funded. So we're going to be focusing on slightly different aspects of monitoring as well as assuming that platform chooses certain level of screening activity at the beginning. So that's the new element, I would think. There are other traditional literature on the crowdfunding more generally, and the basic finding is that the crowdfunding works well. So compared to say experts and etc. They select also overall a good project that's not likely to default worse than any say credit scores do. And also, however, there are some other studies that saying the investors still suffer various biases such as information cascade. I think both elements are in this working in this kind of platform. And as for the signaling aspects, there are also related studies. For instance, Gindin says, the amount of funding entrepreneurs try to raise signals something about their demand. And also Kawai et al. Says, entrepreneurs can signal their inside information through the interest rate on these crowdfunding platforms. So somewhat related to our thesis. The most related paper perhaps is the Nosko and Tadelis. They study these on eBay sales platform. So if a consumer have a bad experience from a seller on eBay, then they're going to have a bad impression, so-called, on throughout the platform itself, the eBay, for other sellers. So this is what I think this is the first study that put forward these so-called reputational externalities based on at the platform-wide level, and we are essentially doing it, re-examining it in the crowdfunding space. But also in the crowdfunding space, coming at Dell, they did investigate what due diligence policies are there at the platform level and how the platform's aggregate funding level correlates. It does, in fact, correlate with that due diligence policies at the platform level. And also, Sin, um, she examined the Prosper microdata and then looked at the effect of repeat borrowers. And then one conclusion is that if you can't observe the repeat borrowers, the information, then the market may collapse. So this is one of the findings which could be similar to the adverse selection market breakdown, etc. So our paper is kind of related all three, but it's not like not exactly like any of these three. So we're trying to sort of combine these three approaches into a single framework. Okay, so our model briefly. So at the beginning of the game, platform chooses the screening technology. It's a fixed cost. So once they set it up, it runs continuously throughout the game. So we're imagining it as like setting up a policy and process and required, some you have to get some service to pull the screening data and then hire some people and set up cost. And once that screening level is set up and then time starts rolling in, and each period, the project borrowers or creators, they arrive, and then the platform's gonna screen projects, and with that probability f of alpha, so as a function of screening level, the project's not gonna make it to the platform, so the screening will fail with that probability f of alpha. And then investors are given a chance to invest with a certain probability, which means that not every investors will get to have a chance to invest. It could be that some investors are not looking at the investors at the platform at the moment, but also because investors are much larger than what each of these projects are willing to or interested in raising money. So if they're raising, say, only 10K, it's not like every investors will get to invest. So that's what's captured by beta. Um, but then, so beta is what essentially later on captures the informational environment, because if you do observe other people's project outcome, then beta doesn't mean much in terms of information environment, because I get to observe the past project outcome, whether I invested with probability beta or not. But in a kind of factual private investment information environment, then only with probability beta, I will get to participate in the project and observe my own investment outcome. That's less than probability one event. So that's what's driving in terms of differentiating a public environment versus private environment a little bit later in the slide. So other elements are just simplified. So platform receives a revenue commission, which is fixed. And then in terms of how the funded project unfolds, the shock occurs with probability P. And if that happens, then the project fails, default. So it's nothing to talk about there. It's just there was a bad shock. The goods doesn't sell, it fails. So if there's no shock, then the project succeeds with a certain probability alpha. So it depends on the screening level. If the screening was bad, then the project succeeds. Even if there were no shock, it's going to be low. But if that screening level were high, project's more likely to succeed, conditional on not having a shock. So the rest is that, again, simplified. The platform decides to monitor at a fixed cost E, enforcement cost, and the borrowers can default like a moral hazard if the platform doesn't monitor. And investors abstain for T period. It's the punishment phase, essentially, if a default outcome is observed in the previous period. So this is following the standard game theoretic framework. Okay. So in terms of model analysis, briefly, so we start from state A, that is when the platform begins. Nothing had happened, so investors get benefit of doubt. So we are in a no default state, but that no default state may change to a default state whenever there's a first project that gets defaulted. Um, so in terms of a value function, then it's a bit of a messy expression, but essentially there's a revenue minus enforcement cost, assuming the platform enforces in a good state. And then when there's a no shock and the screening is good, then you go on to the A state. Whereas with the other complementary probability, you go into the bad state. and that is conditional on 1 minus F, meaning that the project passes the platform screening. Otherwise, no project launches. So if no project launches, we simply go to the another state A in the following state. It's just that there's no revenue to make this state. So VB in the second line means the bad state started, so you have to wait for T periods until people start investing again. So go back to the A state, VA. So with this two value function, the platform maximizes starting from A state, good state, maximizes the present discounted value and minus the cost of setting up the screening technology as a function of alpha. And then we want to impose a monitoring incentive where the VA, which is the regular present discounted value, would be greater once the game start rolling, is greater than when the platform shirks. So when the platform shirks, it's going to save the enforcement cost, so it's going to get all the revenues from commission. But then it is for sure that the state's going to go into the bad state because the project owner is going to default without monitoring. And then the rest is 1 minus F, meaning that there's a project. Otherwise, we go on to the no project and roll back to the A state. So that's the basic analysis. So a result is that which is intuitive, that there is a minimum punishment length such that if the punishment is longer than a certain minimum, essentially users can enforce the platform to monitor. You can imagine that if the user is going to indefinitely keep punishing or very harshly punishing, then there's no incentive for the platform to shirk and try to save that enforcement cost. And so among these possible T's, we're going to assume the constraint efficient solution. We assume that users can sort of coordinate and get onto this constraint efficient solution by punishing the least amount just to incentivize the platform to screen. And our basic existence result is that as long as the cost is small, there's an interior solution for monitoring level. And intuition is visually quite clear. So as long as the C function, the cost curve is not way above that revenue present discounted value, V of A, then there will be some positive surplus in between these two. And these present discounted value, which is not a straightforward function, but at least locally it is that concave shape. So there would be at least one interior solution. That's what we are claiming here. So let's go to the counterfactual environment where suppose investors do not observe project outcomes for other people's projects. So you only get to observe the project default outcome only if you had invested, which occurs with probability beta for a representative consumer or the users. So in that case, what would happen? That's our main theoretical prediction. So so far our result is that suppose the optimal punishment length stays the same, then the result is if that F screening rate exhibits increasing hazard rate, which we think is relatively minor assumption, that is, if the screening rate gets higher and higher, the more likely the project's not going to make it to the past the platform screening and launch. What is rather tricky is that optimal punishment length staying put, which is for a simplicity. One might think that okay, if I can't observe other people's project, then the user should be punishing for longer period of time, which is possible. But we sort of needed to, for now, impose that constant T period because otherwise it's going to get rather ambiguous prediction. Whereas if T, which is an integer, there's some room where the change is not too big, the T period, the integer optimal T star is going to remain constant. And the reason is, okay, if you look at this graph, if in a private environment, if not every investors get to observe every other investor's project outcome, then they're more likely, some of them not be able to know what's going on, then they will keep investing. They're not going to punish the platform even if the project actually fails just because they don't get to observe that. So the platform's present discounted value, V of A, tend to increase. and an increase in this particular manner so that alpha at the peak moves to the left side. And that is due to holding the T star period sort of constant. So if the T star becomes harsher and longer, it may be possible that these new present discounted value function is higher and moved to the right, but it is kind of general expression, so there isn't a clear way so far. We haven't found that we can sort of impose a condition where it guarantees that the optimal screening level moves to the left, i.e., the screening level decreases. That is, in a private environment, because people don't get to observe other projects' outcome. At the beginning of the game, the platform can lower the screening level, which is quite intuitive results, but it wasn't as straightforward as was formulated in this problem. Uh, okay. So now we're gonna go to that data. So the data comes from this imaginary platform from mid 2010s. We had to wait several years because the data is quite sensitive in nature. So this table one is about the project level description. There are about 300 projects. So registered users, meaning because we get to observe all the users with account who created account, and we essentially look at the user's tenure. So from the first time the account was created until the last login. So as you imagine, in many digital platforms, many users just drop out after just a few days or even one day. So we're going only to count those active users during their tenure, active tenure. Um, and some of them, yes, there are some people, some users who are keep continuing to logging in after whatever number of years. They are there, but we're gonna cut off those users who stopped way before our time period ends, and we can only look at them. So for average project, total registered users about 1,000 people, active potential market, potential donors. And then out of 1,000 potential users, they get investment from about 60 users. And the total invested, committed, pledged, it's about $20,000. And the last two line, ever 2 weeks late, means that whether a project during the committed period time, during the installment period, whether the project ever had 1 month or 2 weeks late after that due date for installment payment. We said ever because it is possible that although the project was, past the due date at a certain installment date, it is possible that the project get back to the schedule, the payback, and then in the second installment, third installment, they will pay back all right on the time. But still, this ever means that there are some non-trivial. Now, it's not like very small number of project who get back on track, but there are some project that was once late, but then get back on track. Or others, I think more, they once they are late, they are late. They probably default not paying back much at all. So this is our flagging for those defaulting projects. Okay. And this is our user level data. Users transactions are matched to the project IDs. So essentially, for that during active period of a users, total project that was launched was about 56. And then out of which typical user invested in about three projects. And the total across the three projects, they invested about $1,000. So per each project, they invested about $500. So I think it's different from a small crowdfunding for, say, Kickstarter, where you chip in $10, $20, because the amount is rather high. They're actually the profit motivated. It seems like, because they invest a significant $500 and then expect some money back. So user tenure varies widely from like the same day to throughout the period, our sample period, but they average usually last about 2 months or so. And the last four columns in terms of percentages. So private means out of my own investment. So for a typical user, user is not going to invest a whole lot of projects. So either typically start out the private signal start out zero. So tend to stay zero because as long as I select well those few projects, then nothing's going to default from my own investment, in which case the signal is zero. Whereas if I invest in one project and that project defaults, then it's going to be like 100%. So there's a wide swing. But on overall, across all the people, that percentage of bad experience is rather small. It's like 1.5% of whole time for across users. They are having a bad signal from their own investment. In terms of public, the platform-wide signal out of across the time and users, about 10% of those users, they observe that 10% of the project has been that was launched on profit platform when a stray it has defaulted or these 2 weeks late, 1 month late, respectively 11%, 8%. So it's not too high, but also not too small. So 10% of the time, you know the project has defaulted. Okay, so that is the environment. Um, okay. Okay, and we also fielded our own survey up against the underwriters. So this is an expert. So we just recruited from online the lead, so-called lead underwriter, uh, and that person was from a direct. It's in the same line of business, but it's a direct lender. It's online, but it's not a crowdfunded capital fund, but it's a direct lender. But the specialty is the same. They screen the small businesses, retail businesses, make the same type of inventory loans. So that underwriter team went through our 300 project and they just rated these 1 to 5 scale. We asked these questions one through six, and the purpose was to later on when we needed some kind of measurement of how risky these projects are and how what the screening level would have been if it were done by expert, because the our in our sample the screening was done by that platform itself, and platform it need not be very big, right? We're not imagining like Lending Club or Prosper, but it is a small crowdfunding platform. So we wanted some other measurement of what the screening would have been had it been done by some more expert, seasoned experts, etc. So, and the question 4, 5, etc., was to validate whether the expert was doing a good job or be able to predict the actual outcome, etc. So, we're going to be using that a little bit. So our basic empirical model is this. We're going to be looking at the extensive margin and intensive margin of investment. So this is an extensive margin binary investment decision. It's very simple, right? If we're going to put in the percentage of project, each user at given time, observe at that time what percent of the project has failed, which is a public signal, or privately just among those subset that the user had invested. And then we're going to throw in some control variables that is available, like how many investment the user has made thus far, or whether the user hasn't invested anything thus far, or what the user tenure is. So this is the standard panel model. And this is a result. So our first result is that, okay, so column 1 and 2, we look at the 2 weeks late, and then column 3 and 4, we basically replicate it with 1 month late signal. So they're essentially the same thing. So in column 1 and 2, we see that at the top, the public signal does have negative and significant effect on investment decision. So if the public signal increases by 1%, so 1% more bad project, then it will decrease the investment chance by 2.5%. Same in column 2. So what the column 2 shows that interestingly is that the private signal does have some additional effect, but then the magnitude is much, much smaller. So from that coefficient, you can imagine that when we do the simulation, the effect from private signal itself will be quite small, economically small compared to effect from public signal. So that means individuals, users don't really are not really affected by their own experience, which was a little bit maybe surprising to some of you, some of us. But mostly decision to keep investing in next project or not comes from the platform-wide outcome. So you might think that users are more rational than behavioral because they don't base their investment decision too much on their own private signal. Um, and Column 3 and 4 is the same thing, but the public signal is not significant. So by which our interpretation is that by the time the installment payment is 1 month late, it is way too kind of late. So users have already made their decision by, say, 2 weeks time. So we think that 2 weeks late is a correct signal, whereas 1 month late signal is kind of too late. So it doesn't really correlate or predict well whether you're just gonna make investment in the next project or not. Um, that's our interpretation. Okay. So the second, at the intensive margin, we want to look at the investment dollar, how much the long investment dollar varies with this public and private signal. So we estimate the same investment equation. The only difference is that in the control set, we're going to pull out the user tenure because this is a selection model, because we only get to observe the investment dollar if the user invests. So we want to control for that possibility by throwing in that the predicted probability of investment, which is the hat, which is in the second line, that is estimated probability of binary decision from the first stage, and that is there. But also in control set 2, we pulled out user tenure. That is, we're assuming user tenure doesn't really affect the investment dollar. That is, whether a user has been around long time or very short time, it's not going to affect his or her investment dollar. That is our exclusion assumption. And of course, we have to get some reasonable ground for that exclusion assumption, which comes from this. So this is another survey that was done by the platform itself that was independent of us. They actually have done this before they dumped the data. So according to that, the platform's own user survey, this is about their own user, not the random people or third party population. So their users did answer, say, these two questions. There were other questions, but these 1 and 2, their own users, they answered how likely they're going to use the platform again. So that sort of correlates the tenure. And second question, they also rated how much they're risk tolerant when it comes to the alternative investment, like the crowdfunding. So these two ratings, when we did a simple bivariate correlation, it doesn't really correlate that much. It's about 1.15. So 0.15 is the bivariate correlation, which we thought is quite low. And in fact, in table 5, we dug up a little bit more and we related these two outcomes according to the user self-reported attributes. So for instance, if you look at the third and fourth one, so if you have a high household income and you have many years of investment experience, then the column 2 says you are more likely to be risk tolerant. And therefore, standard theory implies that you are more likely to increase your investment dollar, allocate more money into risky assets. However, that doesn't affect anything on answering to question number 1, whether that person is willing to keep using it, the platform again. So that is we thought is a concrete sort of evidence that there may be, it's less likely that these user tenure will affect the investment dollar. So yeah, that's our rationale for excluding the user tenure. Of course, there are some variable like female that affects both, which we won't be able to capture other than the fixed effects. But overall, we thought that this signals that the correlation between these two, the behavioral correlation isn't too high. Okay, so this is the result of that second regression equation. The result is quite simple. That is, none of these signals matter. So this public signal, private signal, it just doesn't matter in terms of how much each user is going to invest. So which simplifies our upcoming simulation in terms of drawing these actual dollar amounts because it's not affected by its signals. Okay, so our main quantifying the effects of these information environment, it starts from like this. So we're going to be considering the current default environment where users can observe everything, the other people's project, that is the outcome of project that was ever launched on that platform. But we can also suppress, say, there's no private signal, which is done by suppressing the coefficient on that private signal to zero. So it's as if there's no effect from observing private signal. Or alternatively, we suppress the public signal so that the coefficient on public signal is zero, which means that you're not really observing the platform-wide default rate, and then how that's going to change your intensive extensive margin the decisions. And we're going to simultaneously, feed into, we're going to change the screening level of the platform. That is, the default simulation will be, we're going to using all 300 projects, but then we can gradually increase the screening level so that we're going to drop out the weaker project according to the expert ratings, which is what we call the riskiness measure. So if we keep increasing that riskiness measure above which the according to the expert project's gonna trigger into and filter into the launch, then they're gonna have users gonna have a smaller set of projects. So number of projects are small, but then it's a stronger according to the expert rating. So they're less likely to default. So the signal is gonna improve over time throughout the sample period. So there's a trade-off in terms of reducing the number of projects that is filtering out the bad project and the improving those two signals over time. So that's what we're gonna show in the other dimension in terms of increasing the screening level. So as for how the simulation was done, which is quite standard, I think it's this starting from time zero. We're going to simulate all the users in the sample, the active tenure, their users' decision to invest, and then we can also draw the dollar amount. And when the dollar amount is drawn, it's going to be either the actual dollar amount or the simulated if that's kind of actual investment. And then after that first period, we can update the signal, that is whether the project defaulted or not, according to the data. And then we're going to go to the next period and then do the same thing and keep moving on to second, third period, etc. And by that way, at the end of that sample period, we're going to be able to collect how much the platform has generated in total across all the project. And by project quality, we can also try to see, so we're going to be differentiating whether project was above the average rating or below the average quality rating. So whether how much money is going to the above average versus below average projects, etc. So before we get to that simulation result, we want to briefly mention the riskiness measure and the quality measure, which comes from our expert rating. Expert survey suggests that, as I mentioned, we asked these questions, question 1 through question 6, and we ran a brief correlation with that actual outcomes, 1 month late or 2 weeks late, and we observed these correlations. So the pattern suggests that question 3, for instance, is the largest in terms of magnitude and also sort of statistical significance. So if the riskiness of investment was rated high by our underwriter expert, then it is actually more likely to be late in terms of actual data. Whereas question 4 and 5 was also supposed to be quite correlated if the prediction was good, but all these questions, question 3, 4, 5, they're quite highly correlated to each other. The ratings themselves are correlated. So at least question 5 had positive correlation with the actual late outcomes. So our overall sense is that question 3 is the best predictor for this default rate. So we call the question 3. We're going to use question 3 as our measure of project riskiness. There's ex ante screening level had it been done by the expert. So if the expert rated riskiness very high, then that is ex ante risky project more likely to default. In that way, we're going to vary our screening level. Another one is question 1. Question 1 is how likely the business will be successful, and that is sort of negatively related to the default rate as well. But that question we thought is slightly captures different things. That is because it's about overall business success. So we're gonna differentiate that, and we will use that measure as a project quality. And among those ratings for question 1, we're going to just break it into two bins, above average or below the average question one rating, and see whether the platform money will be raised for below average project or above average projects. Okay, so that's the just simple proxies for measurements. Okay, so we only have left our main simulation results. So results are quite simple. So this is a simulated result under the current default environment. So the x-axis vary the screening level. So the first one, all, means we're going to use all 300 projects that was in the data, and we're going to use them in simulation. Uh, Q3 less than 5 means that we're going to toss out those projects with question 3 riskiness rating done by the expert equal to 5. So if expert rated as 5, the highest risky rating, we're going to filter it out as if that it didn't, kind of factually, it didn't pass the screening. And same for question 3 less than 4.5, we're going to filter out 4.5 as well as 5, etc. So as the x-axis moves on, we're going to filter out more of those higher rated, higher riskiness project rated by as rated by the expert. So there are less project there. So in terms of y-axis, that is platform-wide investment dollar, how much has been pledged and actually funded. So the result is as you see here, that it is a slightly non-linear. So that means that you could have raised more money if you had you filtered out the ratings 5, the most highest risky project, and filter out a little bit of a more project. However, this should be consistent with the theory that the platform may be doing optimally because the optimal screening level alpha occurred slightly to the left of that peak. So because there's a screening setup cost, C of alpha, so at least according to our framework, as it is, although platform could raise more revenue by being slightly more stringent, taking into account the cost of screening, we think that this may be close to being optimal. So this is the default environment. So the next environment is no private signals. We're going to suppress the effect of private signal to 0. And unsurprisingly, I'm going to switch back and forth A and B. The picture is pretty much similar, very similar. So there isn't just economically much impact from observing private signal. It slightly discourages me to invest. So if there's no private signal, which is just counterfactual exercise that there is no such effect from psychological or behavioral effect of having a bad experience, then users are likely to invest a little bit more, but then it's going to be just swamped by the effect of other public signal. So it turns out that in our data set, users are relatively rational because they base their decision mostly at the platform level signal. Whereas this is the no public signal counterfactual. So we suppress the effect of public signal to 0. As you see here, it is linear monotone decreasing. So as you screening more and more, platform just end up getting less investment because there's much less punishment because investors don't observe potential default, some of them. So in this case, the platform's incentive is given the monotone downward sloping thing, and given our theory, we conjecture that the screening level would likely decrease because the alpha tends to occur to the left of the peak, and the peak hasn't been shown here. I mean, if we keep decreasing the screening level, it might actually keep increasing to the left of this graph, although we didn't have the sample that we don't observe. So it is potentially possible. So the main conclusion is that if there were no public signal, then it's likely the platform may lower the alpha, the screening standards, further to the left, to lower level. So that is our papers so far, essentially. So without public signal, we think that whether this is socially beneficial to increase or decrease screening level, that is a little more subtle question. we think that that depends on the environment. So if the platform was funding too small a project, many people were valuable project, but they were too small, they were too cautious, then maybe not a good idea to be too stringent in terms of screening. So they could, in fact, sort of expand the number of project fund better, although with slightly more default. Whereas the platform was not, many projects were defaulting, then it may be indeed beneficial to keep that environment to reduce to contain the default rate as well. So which one is likely? We can't really ex ante we can tell. It depends on the specific platform. But what we does show is that first, public signal matters. It will reduce the screening, and second, private signal doesn't have that much of an impact. So it's mostly it's important that platform do the due diligence and then record and disclose that outcomes of their the funded projects. Okay, thank you. That's our
Great. Well, thank you so much. Um, we'll open things up for questions. I don't know. I don't think we have anything in the chat right now. Um, and if there aren't any, I'll ask a question. Um, so um, yeah, let me ask one. I'm wondering a little bit about, I guess I'll call these general equilibrium effects of all this. In other words, once you ratchet up monitoring or screening, it's going to change the distribution of investors and investment projects. Now, this is not, well, I wish I had a more constructive comment because it's more like something that strikes me as like potentially first order important. My guess is this will make the theory almost impossible to do much with, but I don't know if this is something you've tried to deal with.
right. Indeed, if the platform were to change the screening level, people could conceive it over time potentially. It's a different platform, so the user population can turn over. Also, the project creator is going to turn over depending on their perception of screening level, um, which is a good point. On the short right, that will take some time because that screening level isn't openly just explained in detail. So all these crowdfunding platforms they have a very short description how they screen them based on the blah 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 these credit scores, etc. And same for this, they're not very explicit about how detailed they screen. So users may not directly capture that level of screening just by reading their policies, but over time by observing that, yeah, you're right, the project outcomes they may update their belief, then it will naturally change. That we don't have none of those heterogeneity in terms of project creators and the users. Um, yeah, but that effect could be, yeah, certainly there. Right.
Um,
Right. Yeah, let me ask a question too. So, yeah, in many ways, it strike me, the setup, it strike me as something quite similar to other digital platform like Uber or Airbnb in the sense that there's a platform and then there's two-sided and can I kind of use your framework to think about how Uber or Airbnb, these kind of digital platform monitor or screen out some of the drivers or hosts from the platform? Because I mean, I'm sure they do some kind of screening too, right? And they also have some kind of rating system, which is, well, in this setting, it's the default rate, right? Uh, to some extent. So I mean, in a lot of ways, that strike me that yeah, your theory, your model can be applicable to those kind of platforms too, right? Am I thinking it right or?
Oh, yeah, yes, that's a very interesting point. Yeah, thank you for that. Yes, indeed, you could these Airbnb, Uber, they could also decide how stringent they're gonna screen these people who provide services and goods and services on their platform, and um, right, whether to make that outcome visible. It seems like Airbnb is a public. You can observe that public ratings. Uber seems to be sort of private environment because you only get to observe the driver's rating when you are matched. Am I right? So for Uber, users don't get to select these among the different drivers, but they do match. Whereas I guess Airbnb, you observe, you choose yourself as a user.
Yeah, and
So
Uber they do screen out some driver too, right? I mean, I saw news like kind of half recently that there's some driver did something bad where when they're doing Uber, and then Uber did kick them out from the platform. So I guess I mean in your case it could be that the platform could kick those borrowers out if they defaulted a few times
right,
from the platform, right? So which is similar in that sense too, I think.
right. Yes, that's yeah, that's true. Uber could yeah, it's going to be interesting to see how the Uber changes how much they are willing to kick out the drivers depending on what they did, whether it's going to improve their platform or not, right?
Other questions? I'll ask another one. Are there I forgot what to call them, project people posing projects for funding or firms, I guess. Are there repeat are there firms that come back for a second time and like what happens with them? Because presumably that could tell us a little bit about how people infer, what kind of past information they're using to make investment decisions. Is that something that's, I know the sample size isn't all that big. I don't know if there's a lot of those.
There are some who have returned 2 times and 3 times, I think up to say 4 times, although there are less project coming up. But then it could be that similar to that Shin paper at the beginning I mentioned, you do well 1 time, 2 time, and then third time, boom, you could default, or fourth time you could default, for instance. So there seems to be some effect like that, but we didn't focus on that aspect, and like Shin did. So yes.
I have a question, Eric Lang.
Mhm.
Do you have any opportunity, if your data allows it, to follow up on the companies that got investments? Because what I'm curious about is if there is differences in payoff curves. Because of course, if there's one lending platform for all users, then they maybe don't have the incentive to increase the screening efforts, right? But if I would want to start my own lending platform now and could promise the users a very good reward profile by doing aggressive screening, then this could also be very interesting to justify maybe a shift on your screening intensiveness. But yeah, it sounded a bit like your data was highly
Mhm.
data to handle. I don't know what's possible
Right.
there.
So you mean the business of the platform, or the business of the funded project?
Exactly. If you could, as like, right, if the type of, I don't know if you can match the data, but if you have information, they receive a follow-up round, or if there are IPOs or whatever, right? If there are certain returns attached to kinds or classes of projects, right? If the returns in the one that are not screened out are similar to the ones that are screened out, right? As in, risk does not mean necessarily more reward, then this could be like an incentive for the platform to actually increase the screening strictness, right?
I see. By observing the repeat borrowers
Or by
when.
following up on the companies that got investment.
Mhm.
Not necessarily on the platform, but in general, in terms of their life cycle.
Right. Yes, that's a very good idea. We hadn't thought about that, and there's only one platform. Like whether we obviously don't know whether these companies went to a different crowdfunding platform or direct lenders, but by yeah, it is possible that the platform could change the lending terms depending on whether you're the second or third, fourth time repeating, and then that change the risk profile and how they're gonna mitigate the risk based on the loan terms, as well as the screening standards. Those two could interact, I think, as you mentioned. So it could affect the how much the company will raise in the end. Both of them, screening. Yes, I agree. Screening and the loan terms, right? Thanks. Thank you. Right.
Okay. Any other questions or comments for Jin? Okay, well, I think that's it. So I guess we can wrap things up. Thank you again, Jin. This was a great kickoff to our seminar series. So thank you for presenting. Just a quick note: our next Vidi seminar will be October 8th, which is actually the second Wednesday of October because of Yom Kippur is on the previous Wednesday, and Pinar Yadirim from Penn from Wharton will be presenting. So anyway, I'll see everybody next month, and I'll see everybody then. Okay, thanks.
Thank you.
Thanks. And Jin, all the questions and everything will be on the posted video when we put it up.
Sure, sure. Thank you.
Okay, great. And thank you again. I appreciate it.
Have a good day.
Yeah, you
Thanks.
too.
Bye.
Bye.